Let's make a case for mortgage rates. Peter D'Angelo from Guaranteed Rate here. I've been asked this question a ton lately. Where are rates going? I see they're coming down a little bit. Are they going to continue going down? Should I hold off on getting pre approved or hold off on my current home search until rates go lower? My answer is no, but why? That's why I thought it'd be prudent to take some time, review mortgage rates, what affects them, and maybe after taking a look through some trends in history, we can get some insight as to where rates could possibly be going as we wrap up this year and head into next year. There's going to be a lot of information we go over, but if you're a visual person or would like to refer, there is a link to a LinkedIn article that's a companion piece to this video. So I encourage you to check that out if you'd like to refer back to any of the graphs or any of the information that we go over here. Additionally, this is my opinion and my opinion alone. It's not reflective of anyone other than myself. And also, I am a mortgage banker. I am not a financial advisor, and this should not be taken as financial advice. Before we delve into anything else, we should establish a baseline of understanding of a few key concepts. This is going to help us to really get the most out of everything we're about to look at. First things first, the 10-year Treasury Bond, 10-year constant maturity. What is it? Why are we looking at it? Well, we're looking at it because 30-year fixed rate mortgages are very closely tied to the 10-year bond. So anything that's going on with the bond is going to be reflective of what's going to be happening for the 30-year mortgage rate. What is a bond? A bond is debt that the US government sells to investors to gain funding so the government can be funded properly. And in return, the government pays a prescribed amount of money for that bond at a prescribed date in the future. Let's put it into numbers. If there's a 10-year bond that the government is saying this is going to be worth $100 in 10 years, and you buy that bond for $75, in 10 years, when you redeem that bond and you get $100, you've made $25. And that $25 is what we refer to as the yield. It's commonly expressed as a percentage. Secondly, the Fed fund rate. The Federal Reserve of the United States creates the Fed fund rate because that is the rate at which they lend their money out. That has trickle down effects. Banking institutions and lending institutions sometimes will borrow money from the Fed, and that will affect your rate as a consumer for credit cards, personal loans, home equity lines of credit, mortgages. We're also going to look at inflation, the third thing. Inflation is essentially the difference in how much more expensive things get over time. And lastly, we're going to be looking at the difference between the 10-year constant maturity, that 10-year bond we just talked about, and the Fed fund rate. So 10-year constant maturity minus the Fed fund rate and the spread between those two. That's going to be an important aspect as we look through the past 50 years or so of market data that's going to help us to establish some trends here. Throwing up the graph now for you to check out. And in this graph, it's colored with the concepts that we just went over. So the red line is the average 30-year fixed rate mortgage month over month. The next line down is the purple line, which is the Fed fund rate. The green line is inflation, appropriately colored. And the blue line is the difference between the 10-year constant maturity and the Fed fund rate. If you notice there, it goes below zero. That means at those times, there was a negative relationship. So the Fed fund rate was higher than the 10-year Treasury bond. And that's why it's negative. You'll also notice that as inflation goes up, you'll see the Fed fund rate goes up. Why does that happen? The Fed fund rate goes up in those times because when inflation goes high, it's almost at 5% there prior to 1990 in the late 80s, and the Fed will raise their rate at which it costs to borrow the money. And what that does is it helps to take the inflation out of the equation, helps bring inflation down, and you see that throughout the trends here throughout the history. The gray bars are moments of recession in the economy. So 1990, 2000, 2001, 2008, the great financial crisis. There was a little bit of a recession in 2020 before the pandemic and around the time of the pandemic. As you notice, the trend here is downward for the 30-year mortgage rate up until the past 2 years, and then started ticking up again and in tandem with the Federal Reserve's Fed fund rate. We're going to do a couple quick zoom ins on this graph. So the first zoom in we're going to do is from 1987 to 1999. And this is that recession that occurred in the 90 to 91 range. We see here inflation goes up. The Fed raises their fund rate to help bring inflation down. Obviously, there's a lag. Inflation is still going up a bit after the Fed goes and hikes their rate, but eventually inflation comes down. But as that's occurring, we see that negative relationship happening. Mortgage rates start coming down. Boom, we hit a recession. Now we're going to go take a look at the next time period. Before 2000, 2001, dot-com bubble burst. Here we see the same script playing out. Fed raises the rate to bring inflation down. It's sitting around 3.5%, still a little too hot. 2% is normally the target for inflation. So that's why we see that happen every time the green line goes above 2%. We see that the Federal Reserve Fed fund rate goes up a little bit. And then sure enough, negative correlation between the 10-year and the Fed fund rate, recession. Next, 2008 Great Financial Crisis. We see inflation up. It starts peaking up to almost 4% at one point. The Fed fund rate's up above 5%. And we see the mortgage rates are well above 6%. And there's a negative correlation there because inflation came down. The Fed fund rate stayed elevated, but there's a number of different things that were happening in the economy. If you're really interested in learning more about this time period, The Big Short is a great film to check out. Definitely dives deep into this, and it's very entertaining the way that it's presented. So check that out if you'd like to learn more about the Great Financial Crisis. But we're going to hang on to this graph for a bit because we see that purple line go down to that 0 point, and you can barely even see it. This occurred because the Fed was trying to stabilize the economy after the Great Financial Crisis. That's what brought our lending environment to near zero rates. This was something to help stabilize the economy, but in the long term was not something that was going to be sustainable forever. So I want to make sure that we're looking at this graph and we contextualize that this recent run up in rates, as painful as it's been to our pocket and maybe as painful as it's been to some homeowners who were priced out of the market because of high interest rates, the lending environment of 15 years plus that preceded the pandemic was truly out of characteristic of any other time in history. And that ultra low rate environment is not something that's sustainable or good for the economy at large. And we're paying for that now. And that's why could be a good reason why we saw inflation go the way that it did. We saw the economy be super volatile the way that it's been over the past couple years rather. So bear that in mind. It's all about context. The average mortgage rate in the US across history is 7.8%. So right now we're pretty much squarely at average. It just feels worse because we've been so exposed and used to a lower rate environment for so long. So let's skip ahead. Let's move forward. Let's look at more recent time. 2015 through 2023, you see that some of the data stops, like the inflation data and whatnot. That's because this is coming from the St. Louis Fed, Freddie Mac, Board of Governors, and the World Bank. Their data is not all in yet. I will do a video in the future and hopefully break that down further, and we can see how these trends continue to transpire. But we see that little recession that happened, and we've said recession a number of times. Recession is described and pretty much determined by a compression in the market, meaning that the stock market drops a certain amount of percent, and that indicates recession. Very rarely I don't think we ever have been in a recession and someone said we are currently in one and they were accurate. Normally recessions are looked at in context and usually through a rearview mirror. As we see here, that blue line dips down again and we hit a recession and inflation runs up like crazy. We've all heard this. It's been all over the news for a while. Recently, we saw inflation cool, which is good. But now as we take a look, the Fed cut the rate to zero again to stabilize the economy while we were dealing with the pandemic and the after effects. Then the Fed went on their interest rate raising campaign and brought that rate up. And so we see the Fed fund rate and mortgage rates in tandem moving upward. However, we see that there's a negative relationship between the Fed fund rate and the 10-year bond, which has been a precursor of every recession. I'm not being an alarmist. I'm not saying, oh my God, we're heading for a recession. There are plenty of signs of recession that flash that doesn't happen. In this case right now, I'm of the opinion that the Fed is actually doing a decent job at bringing inflation down, but inflation's sticky. We have recent reports over the past 4 months of inflation being much lower than the near 9% we saw last year. So that's good, but it's still high and there's still work to be done. I think that the rate environment is very likely going to remain elevated for a bit, but here's where the good news is. I don't know that I would feel comfortable making a case saying, oh, yeah, rates are going to drop, hang in there or wait it out. I think that because the Fed's been raising the rate ever since the pandemic, we haven't had a quasi normal or normal ish environment to see interest rates. Everything's been very volatile. That's why homeowners could be placing an offer, or would be homeowners would place an offer on Friday, and then by Monday, the rate could go up and they could be priced out of that property that they placed a pre approval and placed a bid on. I think that if the Fed stops raising rates and they say, we're happy with how our rate environment is currently helping to bring down inflation and it's not sending the economy into a recession in a big way, we're just going to remain at an elevated level for a while. This is the type of speech and the type of language that's been used lately. So that's what my indication is, that we should see a consistent rate environment. The thing to bear in mind is the rate environment is going to change. It's always going to change. Waiting it out, though, will not necessarily mean it's the right thing to do. Here's my case. If rates go down, let's think logically through this. If rates go down, you've got more buying power. That's great. You're not the only one, though. And there's other people who will have more buying power. And now you've got more competition in a market where we still see historically low supply of inventory. Low supply, high demand, prices go up. Econ 101. So, a lower rate environment does not necessitate a better opportunity to buy because there's going to be more buyers out there. There's a ton of buyers sitting on the sideline, whether they're disheartened, discouraged, or plainly priced out of being able to purchase what they desire. There's a lot on the sideline. So when affordability increases, there's going to be more people in the game again. My opinion is to get pre-approved and get pre-approved early. There are things that you can do in the pre-approval process that will position you best for when you are ready to take the leap and start looking for a home in earnest. And you can mitigate a lot of problems that could possibly come up in the mortgage process if you get pre-approved early. Keep that in mind. We don't know where these rates are going for sure. Things are still very volatile. But I think that if things remain within a constant margin, we don't see a ton of volatility up and down, peaks and valleys, you're going to see paying for a permanent buy down on your interest rate become a more appealing factor because your money will go further when the rates are not super volatile. When we get even trading, when things are gelling and kind of just moving evenly with just some up and down as normal market movement may have, you will have an opportunity then. I did a video yesterday and I talked about locking a loan for would-be home sellers on behalf of their home buyers. We call that lock it listed at a guaranteed rate. And looking at the rate sheet, 2% buy down points, which is 2% of your loan amount that you pay at closing, can go and almost save a whole percent on your interest rate the way that the rate sheets were breaking down yesterday. That in a $500,000 purchase with 20% down was $297 a month in savings. That's significant. That's a car payment before the crazy run up on interest rates, right? But I hope you found all this information useful. I hope you found it helpful in your own pursuit of home ownership or planning purposes. If you disagree, I would love to hear. If you agree, I'd love to hear. You're encouraged to like, subscribe, comment, email me, text me, call me if you've got questions or would like to talk in greater length. As you can tell, I love this stuff and it resonates with me. It's what I do every day. And these are the types of things that I need to be particularly aware of to advise my clients appropriately to help them in their dreams of home ownership.